Yeah, hi. Hey, everyone. Welcome to our live event tonight. I think it's going to be a really educational evening. I think you're probably going to get some good laughs as well. I was on the call earlier with Meb, and I've already been laughing. He's a very funny guy. He's going to be covering tonight, as Ryan mentioned, a tale of two tales, the melt up and the bear. So my name is Derek Hageman. I'm a financial analyst at AAII. I'm also the editor of AAII's dividend investing service, and I'll be serving as tonight's moderator. It definitely is my pleasure to introduce you to tonight's speaker, Meb Faber, and it's a privilege for me, as AAII members may have seen the cover article of September's journal that I wrote interpreting Meb's unique approach to yield investing from his book, Shareholder Yield. And it looks at dividend payments, share repurchases, and debt paydown. However, I will note that it was not one of his leather-bound books, which is always included as part of his bio. But as Ryan mentioned, Meb is the co-founder and chief investment officer of Cambria Investment Management. He is the manager of Cambria's ETFs and separate accounts. He is also the host of the Meb Faber Show podcast and has authored numerous books. He is a frequent speaker and writer on investment strategies. He's been featured in Barron's, the Wall Street Journal, CNBC, and the New York Times, among others. And in tonight's webinar, Meb is going to review the circumstances of the current market environment and how to participate in a melt up. And he's also going to discuss how to hedge risk using tail risk strategies. So welcome, Meb, and thank you for joining us.
Thank you, Derek. It's great to be here with my AAII friends. Sad we're not in Vegas or Orlando, but also happy that everyone listening, that means you survived 2020 so far, as challenging of a year as it's been. We're not done yet, by the way. Still have 2 months. I don't know how that's possible. Feels like 10 years already, but glad we're all here today. Hopefully everyone has a nice glass of wine, tea, beer, water, whatever you may have. And thanks for taking the time to spend the next hour with us.
Hey, Meb, it's great. Definitely looking forward to this. I was just curious. I know you have you like to, in your free time, you like to do some skiing, you like to surf, and you like to travel. I was just curious, when things, kind of return back to normal, where do you think the first place you would think about traveling to? Any favorite destinations that you're looking forward to getting back to?
I wasn't even waiting for things to get normal. We hit the road this summer when things were pretty abnormal. I got a lot of crew in the Midwest, Colorado and Kansas and thereabouts. And so we did kind of a long 2-month tour in the car, which when you have a 3-year-old is always a little questionable as to the outcome there. But it was great. We went through like 8 or 9 states, spent a lot of time outside. If you're watching this video feed, you can see in the background a beautiful photo I took from the Four Tops Wilderness, which is in western Colorado. We did a little pack trip on horses. So nature tends to be my getaway, but I miss places like New York and Europe and other countries throughout the world. Skiing in Japan was always my go-to, a great secret location, which a lot of people don't know about. We'll talk about Japan some more today. So a lot of places, honestly, but it's beautiful in LA. It's fall time, gorgeous 80-degree weather. So I'm pretty content right now.
Oh, awesome. That's awesome. So, well, hey, just before we get started tonight, I want to remind our audience that we are recording the presentation tonight. So rest assured, you'll be able to see this again. It will be available on our YouTube channel. And I will be here listening for questions. So please go ahead and type your questions into the questions panel. And Meb will be answering questions along the way. So if you have any as the presentation's going on, please feel free to ask them. So I'm just going to turn my camera off here in a second, and I'll be looking for your questions for Meb. So Meb, we look forward to your presentation, and take it away. Thanks.
Cool. Well, Derek, I expect you just be like the voice of God and just chime in when you want to chat about some things.
Definitely.
Oh, hold on a second. Let me get a better view here. All right. Here we are, Los Angeles, California, beautiful sunsets. Hopefully this doesn't have anything to do with any fires going on. But what are we going to talk about today? We're going to talk about a concept that I was talking about back in March. If you're a follower of our blog or podcast, we were talking about all the possible outcomes that can happen with investing. And if 2020 is anything, it's a reminder that normal market returns can be extreme. And even if you have a fairly large grounding in history, that almost anything can happen. So again, we already mentioned this, but for you guys who aren't familiar with us, we got all sorts of free resources. If you go to our website, Camry Investments, you can download most of my books for free. A few of these here on the left. The podcast, which was mentioned, we actually already recorded a couple of fun shows today. One with Joel Greenblatt, which you guys is going to be a great one. Don't miss out on, as well as an interesting one on how to invest in fine art. We're not going to spend much time on this, but my day job is as a fund manager. As much as I like to write and publish research and chat on the pod, you know, our bread and butter is running an ETF business. We have 12 funds, 2 of which we'll mention in passing today, across the board: allocation, value, hedged, bonds, real estate, thematic. But here's the roadmap. And what are we going to talk about today? So we're going to talk a little bit about where we stand today, today's market environment. For those who may have seen me give talks in the past at AAII, I love you guys. So I've done dozens of these across the country in the previous 5-10 years. You may recognize a slide or two, but we're going to talk about how to think about markets. So how to think about, when you think about a distribution, the 2 tails of extreme returns. You know, a lot of people, when they open Barron's at the beginning of the year and they have all the strategists that project their returns for the S&P, they're all almost always cluster around the same numbers, up 8%, maybe up 10, someone crazy is up 5. But the reality is the vast majority of the time, something like 60 or 80%, I think it's 80%, then the returns fall outside of those numbers. You know, you have the up 20, up 30, down 10, down 20. And so thinking about these outcomes, so what we call the right tail is the really big monster move up, a melt up, right? We're at all-time highs in the stock market, or very darn close right now. But also protecting against the really bad times. You know, we've had 2 big bears, excluding 2020, talking about the financial crisis and the internet bubble, where you lost half your money, and that's not even the worst case scenario. And the Great Depression, stock investors lost over 80%. So how do you protect against that? And how do you survive to put both thoughts in your head and not explode? It's tough to do. And then I'm going to save a lot of time for Q&A because there's probably a lot to chat about today. So as you think about stocks, and this really applies to any investments, you know, my favorite investing book is called Triumph of the Optimists. It's expensive. You can get it online, but it's going to cost you like $100. So there's 2 resources. One is you can download a free resource called the Credit Suisse Global Investment Returns Yearbook, and they've put out about 10 of these over the years. And I highly recommend reading all of them because each year touches on a different topic. But what the professors did who published this book is they looked at stock returns going back all the way to 1900. And we had Professor Dimson on the podcast too. Really fun episode. And what they found that stocks did great over the past 120 years. The US is one of the best, not the best, but there was a pretty wide spectrum of returns, and bonds and bills did okay too. The challenge was that depending on where you're born, if you were born in Austria, you basically had no stock returns. If you were born in, say, South Africa and you put all your money in South African stocks, you had incredible returns. But why do I bring this up is when you ask people what they expect on their investments, the way they come up with a number is they simply say, what has happened in the past? And to be clear, that is a pretty good anchor in long periods, 20, 30, 40, 50 years. But in shorter periods of, say, 5 to 10 years, it's not a great indication, because you have periods in regimes where stocks go up a lot, where they go down a lot. And so I'm gonna channel a concept that's over 100 years old, where Professor Bob Shiller based this on a concept of Benjamin Graham, where Benjamin Graham was writing about 5 to 7 years, coming up with a PE ratio for markets where you take an average of a PE ratio of a stock to come up with a signal from the noise. So, you know, 1 year tends to be pretty variable. Look at 2020, for example, try to come up with anything useful out of a 1 year earnings here. And then Professor Shiller said, instead of applying it just to a security, let's apply it to the whole market. And so he came up with this time series that goes all the way back to actually before 1900 into the 1800s. And you can take away some just basic considerations. One is the long-term average is around 17, but at times it's been really high during the roaring 20s, over 100 years ago, man. By the way, if you guys want a good book for the rest of the year, Americana is a history of capitalism, 400 years in the US. It's a lot of fun. Roaring 20s took this PE ratio up to 40, up to 33. But then the Great Depression took it all the way down to 6, just over the course of a couple years. And then at times you see it oscillated up and down, the nifty 50s in the US, and then the big inflation of the 1970s, bottoming out to a level in the single digits in 1982. Remember the death of equities cover from Business Week, and was really as low as it was back during the Great Depression. And then this just massive secular move up in the 80s and 90s that I grew up with as a child, where stocks only went one direction most of the time, culminated at the peak of the internet bubble at a value of almost 45 in 1999, only to have it fall off a cliff and then had it recover a little bit and fall off another cliff in the financial crisis, and got quite cheap in 2009. And then, of course, had this nice rally back up to where it is today, which is in the low 30s. What can we use? What can we extrapolate from valuation? You know, a lot of people make the assumption that value is not a timing tool and value is not helpful. And I do not believe that. In fact, I strongly do not believe that. And in fact, John Bogle didn't believe that. And this may sound like heresy to a lot of people, but Bogle put out an equation in the 90s, and he wouldn't say forecast, but he probably would have said to use it as expectations, which is combining the starting dividend yield of a market, the dividend growth, and then the change in valuation. And you can come up with a pretty good expectation of roughly what stocks will do over the next decade with his model. So right now you plug in the 2% dividend yield, the historic 5% earnings, that gets you to 7. That sounds great, right? Well, the problem is this valuation is pretty high. Even during low inflationary times, around 22, 21, is a lot higher than that. So you probably will face a valuation tailwind over the next decade as multiples settle back to that normal 17 to 22 range. Bogle himself, before he passed, when people asked him for his expectation of stocks for the next 10 years, said 4%. And if you have that multiple contraction down to levels where are what we'd consider to be average, it is in that range. It's a little bit less. It's around 3% in normal inflation, less if you go back to full period average. But you have to at least consider the possibility that the multiple could expand. Again, it's been as high as 33, 44 in the past. It's probably not likely. If we were all in Vegas together, I would say don't go bet the roulette table on these sort of odds. But you also have to expect the possibility that it could sail right through average and go back down to times where it's been as low as 7 or 6. Now, again, as a investor, speculator, allocator, whatever you want to call yourself, you have to at least consider the possibilities. And you come up with a spectrum of future probabilities of what's most likely, what's not. The problem here is that if you ask investors, and you can ask yourself honestly, you can write it down on a piece of paper right now, say, what do you expect on your stock returns in the next 10 years? And almost everyone, survey after survey after survey after survey, says the same thing, which is 10%. And the problem with 10%, you have to have valuation multiples go up from here over the next decade, or have just an amazing earnings renaissance, amazing dividends growth over the next 10 years, because you know where dividend yields are. They're already pretty low. And is that likely? You know, it's possible, but maybe not so likely. So if markets are expensive, and if U.S. market's expensive, and if we know anything, oh, and by the way, I almost don't even want to bring this up because it triggers me every time I talk about it. In the survey from Schroders, where they were talking about expectations, they break it down into countries. Guess who had the highest return expectations in the world? The U.S. at 15% was everyone's answers. Shame on you if you were a part of that survey. I can't believe it. I still can't even digest it. But so if,
Hey, Meb, I just want to jump in here a quick second. There were a couple questions on the Shiller ratio, so I just wanted to ask those since they're timely. So James James asked if you think the Shiller ratio should be adjusted to reflect levels of and changes in interest rates.
It's a good leading question for something we're going to get into a little bit. And the Shiller Cape ratio already adjusts for inflation, and inflation is tied right at the hip to interest rates. And so over the past 10 years, that's the cyclically adjusted part. So it's already adjusting for interest rates. A lot of people, and I put Buffett in this camp, and I disagree with him, but you have so many people that talk about what we describe as the Fed model, which is comparing stocks to interest rates. And it sounds good in theory. I'm going to touch on that in about 5 minutes about why that doesn't hold water. It's something that everyone repeats. I think you hear it on CNBC, you hear it on almost every media outlet, and I disagree. My view is anti-consensus. So I'm not, most people will disagree with me, so take what I have to say for a grain of salt. But we'll get into that in about 5 minutes as to why I think that's that argument doesn't hold water. Also, by the way, in the US, you cannot come up with any variant of this Fed model that is helpful. So you've had periods in the US where you can invest based on interest rate relative to valuations, but for the most part, the minority effect it does have is in that 1 to 4% safe zone of inflation, people will pay more. They'll pay a higher multiple. So I said up around 21 instead of 17. But what happens outside of that 1 to 4% safe zone? So if we have inflation above 4 or deflation or disinflation below 1, the multiples fall off a cliff. So it goes from 21 back down to 17 and then back down to 15, 14, 13, 12. So you got to kind of stay in that safe zone of inflation, but that'll be tied to interest rates. They kind of move together. Long-winded answer to your question.
No, it's great. I think, yeah, there's a couple people asking about interest rates. So yeah, I'd love to hear your non-orthodox thinking. It's always helpful to hear a different side of the story sometimes. So, all right, I think we'll hold on a few other questions for later then.
Yeah, and you know, we only have an hour, but when we talk about Cape ratio, let me say a few more things. Valuation is a blunt tool, and I actually don't care if you use Cape ratio. People's brains kind of explode when you talk about Cape ratio for some reason. Any valuation metric should agree or say the same thing when things are at extremes. If you're doing valuation to 2 decimal points, you're doing it wrong. But when you have something that is very expensive or very cheap, on average, it should be in the same universe. And I don't care. You can use dividends. That's totally fine with me. You can use cash flow. You can use sales, whatever. And we actually, in practice, use a composite of a bunch of measures. But it does at least give you a fundamental anchor from which to make decisions. In no other area of your life, I guarantee you, do you not use valuations. When you go buy a house, there's zero chance you just say, you know, what's the price? Doesn't matter. You know, we'll buy it regardless. This seems like a nice neighborhood. That seems like a somewhat curious way to go about investing. We'll get to that more in a second. So, thing is, as we think about investing in just U.S. stocks, that's not our opportunity set. We live in a global world. This chart, which we just recently updated, shows that U.S. is about 58% of the world's market cap of stocks. That means almost half is the rest of the world. This chart used to be down around 50%, but it waxes and wanes over time. But my point is, there's no reason to just constrain yourself to just one country. But what do most people do? Most people in the US, and we've talked ad nauseum about this, as Vanguard had. We had to take the slide out of the presentation because it was too old. but almost everyone in every one of these countries and regions invests all their money in the same market. So US investors put 80% in the US. Our friends in Japan, UK, Canada, every single country we've ever found invest most of their money into their own market. So if you are listening to this, say, how much of my stock allocation in the US? The answer, I can almost guarantee, is 80%. And people come up with a laundry list of reasons why. They say things like, rule of law, we have a stable geopolitical political scene, which I'd smile about. We have an election coming up in a few weeks. If you talk to anyone else in the world, it doesn't seem that stable. But the funny thing about this is everyone does it, and it's a really foolish mistake, because I guarantee you go ask our friends in Brazil, Russia, Greece, UK, who's going through this whole Brexit mess for, it seems like forever. You say, hey, how good of an idea was it that you put all your money into your own country stock market for the past 10 years? And they would say, that's crazy. Why would anyone do that? But they still do it. But they've been through a long, hard period. Whereas in the US, we've had an amazing run these past 10 years. Amazing. But the thing is, that's not normal. So if you look at my Twitter, if you guys are on Twitter, look at my pinned tweet. I have what's called my 5 favorite resources for international investing. And one of them is a report by Bridgewater that shows the US stock market versus the rest of the world average and GDP weights. And they show that the US demolished the average in this past decade, but actually that's pretty rare. That's only happened a few times. Before this, it happened in the 90s, the roaring internet bubble. Before that, you have to go all the way back to 1920 to find a time when the US outperformed, but people love to extrapolate what's happened recently. And let me show you why. So if we look at the valuation of the US versus the rest of the world, the blue line is the US, the red is the rest of the world. This goes back to 1980. There's a few takeaways. One is they tend to zig and zag. There's times when blue is above red and vice versa. But you can find some peaks. There's that massive Japanese run up in the 80s, which caused the rest of the world to have a CAPE ratio almost as large as the US during the internet bubble. And if you were to pull out Japan in this chart, it would have been almost 100. And just to put that in context, Japan wasn't some tiny country. They're still a top 3 economy in the world. They were the largest stock market in the world in the 1980s. Everyone wanted to invest in Japan. And their bubble was the biggest bubble we've ever seen, twice as big as the US in the internet bubble. But the US was cheap back then in comparison. And then you've had times over the past 20 years where they've kind of zigged and zagged. You see the 90s, the US is more expensive. Then the 2000s, remember, everyone wanted the BRICS, Brazil, Russia, India, China. The rest of the world stomped the US in the 2000s. It sounds like a long time ago, but it wasn't. And then what's happened in the last decade? Wow, look at that alligator jaw of just chompers of the US just ripping and rolling. Both of these markets were in the low teens in 2009. I'm sure everyone was loading up the truck to buy tons of stock in March 2009. Stocks everywhere were cheap. But what's transpired in the decade since? Well, the US has had a monster run. A lot of that's due to multiple expansion, went from 12 to 30. That's just PE ratios, people willing to pay more. The rest of the world, not so much. We wrote an article recently called the biggest valuation spread in 40 years. And we were talking about the US versus the rest of the world. We said 40 years ago, the difference was the US was cheap and the rest of the world was expensive. I want to make 2 more comments on this chart. The first being, if you were to ask people, again, going back to the reasons why the US trades at a valuation PE of around 30 and the rest of the world is much lower, they'll often list all the things that I said earlier. And then which as I respond, I say, well, if the US has a valuation premium and deserves one, like everyone, I think my children, my teams are exceptional, although this year being a Broncos fan is a little tough. So I think the US is exceptional, but how much of a premium is there historically? You should be able to see it. And the answer is there is no valuation premium. If you go back to 1980, the average valuation of the US and the world are both 22. Second, if you say how much of the outperformance of the US has come in the past 10 years, you could go back 40 years, you could go back 70. The US has beaten the rest of the world, has been an exceptional market. All of the outperformance has come since 2009. Now, obviously, you can cherry pick time periods. There's time when the US has been better and worse, but on average, you shouldn't expect the US to be exceptional. And why? Look, we're all humans. You go around the world, you meet entrepreneurs from India, from China, from Africa, from Europe, from South America. They're the best capitalists everywhere. It's not constrained to just one country. So you have this massive valuation spread. So this is everyone's favorite chart. What does the world look like now? If you look at the US, low 30s, foreign developed right around 20, which is totally reasonable. Within foreign developed, there's a pretty wide spread of more expensive, less expensive. Foreign emerging, downright cheap. I was talking a lot about that on Twitter today. And the least expensive bucket is at 10, including a handful of countries that are in the single digits. For the historians out there that can tell which of these flags are what, you can be able to ascertain who's a single digit country, but we update this once a quarter. But the takeaway of this is that, look, do not take away from this talk with me saying the US is a bubble, it's gonna crash and you have to sell all your US stocks. Absolutely not. What you do take away is me saying the US is expensive. It's not crazy, but the US expectations should be lowered. The good news is the rest of the world is reasonable. And in some parts of the world, particularly foreign emerging, and if you tilt towards value within these indices, and then the cheapest bucket of countries, this is out of 45 countries, so call it 12 countries, are screaming cheap, particularly relative to the US. So my takeaway from all of this is that, here, we have a fund that does this. I'm not gonna spend much time on it. It's called GVAL, Global Value, and it picks 12 countries out of the opportunity set, only rebals once a year, has about 100 stocks. You can see the required disclosure performance. It's an ETF. It's got, I think, 90, 100 million in it. Hasn't had great returns. And value, as many know, has struggled not just in the US. I think at one point this year, small cap value was down 50%. That may be too painful for some listeners to relate to, maybe too soon. But it also particularly hasn't worked great globally. But there's a nice resource. This is Morningstar, but other sites have it. I imagine AAII has some ideas like this, where you can type in any fund, and it'll show you the characteristics of the underlying stocks in that fund. You can go do this for your Vanguard dividend funds and be surprised at how expensive they are in the US. You can do this for other funds and come up with an understanding of what you actually hold. The point I wanted to make here is this isn't just a theoretical exercise where we're looking at these CAPE ratios on the indices. You can actually see it in funds too. I don't care if you use ours, but just wanted to demonstrate the vast discrepancy between funds like GVAL, which invest in these really cheap countries, and then the category for this with Morningstar is the foreign, small, and mid, and then the S&P 500. In every case, it's GVAL is cheaper than the S&P and the category, and sometimes it's less than 50% or more than the S&P. You can even be a dividend investor. As much as I like to talk about dividends and buybacks, dividend yield is much higher. It looks like double the US in GVAL. So as you think about stocks and stocks hitting new all-time highs by and of themselves are not bearish. We put out a paper this year about investing in all-time highs. You go to our website, Cambria Investments. It's a really fun paper, and the conclusion is not what you would expect. But when you do align valuation, we think it will be a tailwind. But if you do have a scenario where the markets continue melting up, come up with whatever reason you want to. You can blame it on the Fed. You can blame it on elections, policies, vaccines, who knows what. But if markets are going to market and they just keep going up, in my mind, I would definitely want exposure to the really cheap stuff around the globe, particularly compared to the US, but at least get to neutral. Neutral, by the way, is 50%, 58% US, 42% rest of the world. If you're crazy like I am, you'll tilt even more away from the US. US is only about a quarter of world GDP, but at least get to neutral and then think about valuations.
Hey, Meb, I just have a
yes.
couple questions coming in, and I think they're very good questions. Kevin and Robert had the question, and they just wanted to know your thoughts. They say that roughly 40% of the S&P 500 is actually international based on where these companies are making money. So if we invest only in the US S&P 500, we are actually getting a 60-40 diversification with international stocks. What would be your comment to that?
I love this question because you're absolutely correct. The US gets a fairly significant portion of revenues from abroad. So in that case, why would you pay a 30 PE multiple on that as opposed to paying a 10 or a 21 on foreign companies, which, by the way, if you look at the developed markets universe, I think US is last on percentage of revenue from other countries. So if everything is intertwined, then why wouldn't you want something if they all get revenues from everywhere else? And you're 100% right. I mean, there's companies in the US that have zero US revenue. There's companies in certain indexes that don't even have, and in that tweet is some resources on this exact topic. There's companies in certain indexes that have no revenue at all, even within the country, you know, and so it's a big mix, it's a big mashup. But that's even more of a reason why. So yes, it gives you diversification, but it doesn't tilt you towards value. You end up paying a 30 multiple on companies just because they're based here, as opposed to buying a 10 or 20 multiple on companies that have the same exposure to the US. My whole point as a quant is it makes no sense to arbitrarily constrain your universe. You know, if I can give you the choice of 20,000 global securities, why would you say, you know what, Meb, I'm just going to choose from 30? Why would anyone do that? But people do that all the time. You know, if I was to say, hey, you got to buy a house in Chicago, but you have to only buy it on this one street. You know, your partner, your husband and wife say, I don't want to live there. But say, well, that's just my arbitrary rule. I want to constrain it, so we have to live here. It doesn't make a lot of sense to me. You know, I think that argument, when you actually flip it, is an even better case for not doing market cap weighting. We don't have enough time today to really get into market cap weighting, but I think it's an argument, no matter what, for diversification, and then tilts towards value.
Now, I'll just follow up with another one, Meb. There's a question from Michael. He's asking, and Stephen has the same question, just came through. They want to know if you have any concerns about the high bias of FANG stocks in US performance.
Yeah, the impact of sectors and companies waxes and wanes over time. If you look at energy, which is right now, I think at like 3% of the S&P. At one point it was 23, so pretty big difference. Tech, you know, has that sort of waxing and waning too. And then you have companies that are in other sectors that you could call tech companies that aren't tech companies anyway. A lot of people will talk about the foreign exposure and say, well, the reason the US is more expensive is because it has more tech. It looks more expensive than the rest of the world, which may or may not have as much tech, and yada yada. And they have impacts, but it's not significant enough to account for the difference in valuations. One big point I wanted to make, and we'll get back to the questions though, however, is when you're talking about things like valuation, people will ask me, cocktail parties, when we're hanging out, going for a walk on the beach, they'll say, Meb, how, you know, I bought your fund, or I have this strategy, you know, it hasn't done well in the last 3 months. I bought it 6 months ago. I'm going to give it 6 more months. I said, 6 months? I said, oh, it can perform way worse than that. And I used to say, they will say, well, how long should I give it? And I used to say 10 years. And they'd kind of smile, act like I'm kidding. And I wasn't. And they'd usually end the cocktail conversation. And now I don't say 10, I actually say 20. So if you're going to do the global market portfolio, that's the only true index. Half stocks, half bonds, half US, half foreign. That's the only true index. Everything else is an active bet away from that, by the way. If you're going to stray and you're going to get weird and you're going to tilt towards anything, it could be dogs of the Dow, it could be dividends, it could be extra tilts towards technology or FANG or value in this case, you need to give it a decade. And if you don't, you shouldn't even bother, because what happens is it causes you to behave poorly. And at the first chance of underperformance, usually it's around 2 to 3 years, 2 to 4 years for people. Almost no one gives it longer than that. They'll sell it. And this bad behavior costs not just individuals, it is as bad, if not worse, at pension funds and endowments. All the academic literature supports this. And let me give you an example. If I were to ask the 1,000 odd people listening to this, if I were to say, let's do a poll, do you think stocks outperform bonds over the long term? I would say 100% would say yes. If not 100%, 90, and the other 10 would have just accidentally clicked the wrong thing, or maybe you're asleep. There's no more universally held belief than stocks outperform bonds over time, and I believe that. This year, in 2020, there was a period where stocks versus long-term bonds had the same performance for 40 years. Not 5, not 10, not 20, 40 years. Imagine making that bet 40 years ago. I think stocks outperform in the long term. And waiting 40 years and saying, maybe that's not true. So you have these things that play out over such long periods, and the challenge as an investor, the only thing that matters is getting to the finish line, getting to a point where you survive, you succeed. You want to have that US stock exposure. You want to have global stock exposure is better, but avoid all the problems of the behavioral fractures of causing to sell it. And placing a massive bet on just one country, again, pat yourself on the back. God bless you for the past 10 years. It's been amazing. Past 100 in 20 years has been amazing in the US, but not diversifying, particularly going forward, I think is one of the most foolish things an investor could do in a globalized world. Sorry, I got a little ranty off topic there. Any more questions? You want to keep rolling?
Now let's keep rolling. Plenty of questions coming in though, and I know there'll be plenty of time at the end for Q&A. But now, if there's something really relevant to what you're talking about, I'll definitely chime in. But now let's keep rolling.
So depending on your perspective thus far, the first part of this talk could either be seen as optimistic or pessimistic. I don't know. I think it's optimistic. I think the world is your oyster. There's a ton of opportunity. Almost like the old Jim Rogers books, the investment biker and venture capitalist, like all these places to invest around the world. I think should be a optimistic takeaway. Pour a little cold water and say the U.S. is expensive, but again, it's not the worst. The problem with markets though is, they can do a lot of things. 2020. It feels so long ago, but think back to March. Many of us would have been watching TV, opening our brokerage accounts and just seeing a sea of red, looking at overnight futures and watching them being limit down. I mean, remember back to how that felt. And if you weren't paying attention, you weren't logging in, good for you. But if you were like most of us that have emotions, it was probably pretty painful. And again, the challenge, the only compliment, the only goal of all this is to survive, to get to the finish line with your investing portfolio. And the problem with a lot of investing portfolios is they're either too concentrated, so too much in one asset class like US stocks, or they're structured in a way where you don't have that sleep at night component. And so Bogle used to always say, he says, I put half in stocks and half in bonds, and that way I always worried I have, half time I have too much in stocks, and the other half time I spend having too much in bonds. But we'll talk about something today where, if you think back to March, we wrote an article called Investing in a Time of Corona. And we said, look, US stock market's getting pummeled the fastest it's ever been from all-time high to bear market. And it feels like it's going to get a lot worse. There are scenarios where you could easily have come up with where US stocks sailed right back through average valuations and went down to depression era lows. And we laid out that case, a bear case, where, when all the data was coming out of Italy, where hospitals would be overwhelmed, everything would be shut down, no effective treatments. We maybe had some pause from the virus in the summer, and then the fall, the virus mutates and everything just goes to hell again. And markets just, cratered. That was a very real possibility. On the flip side, we said, look, there's a bull case where fiscal and monetary policy is coordinated. People take this seriously. Treatments are developed. Governments work together. And by the end of the year, markets are hitting all-time highs. Everyone's like, Meb, that's crazy. That will never happen. And here we are. Now, it definitely feels to a lot of people, a little weird. A lot of people feel this sort of Main Street, Wall Street disconnect. I had a tweet where I said, look, if we could go back in time a year, and I'm going to give you all this information, and the only thing I'm not going to give you is where are US stocks. I'm going to tell you that unemployment's going to go from 3 to 15%. Economy goes from expansion to major contraction. Gold is hitting all-time highs. Oil at one point trades negative. All these things going on. Where do you think stocks are? Oh, and interest rates go from 2.5 to 0. Where do you think stocks are? I think the respondents would probably be down 20, 40, 60, 80. I don't think anyone would have set all-time highs, but here we are. So about 4 years ago, we started thinking about this topic where I was looking around. So when we launch funds, for those who know us, we tend to be pretty different. There's 4 criteria we come up with when we're launching a fund. One, that either has to not exist or something we think we do much better or much cheaper. And cheaper is rare these days, but it happens. All 12 of our funds are cheaper than the category average. And some of the funds are the cheapest fund in the entire category. Second is that it has to be something that's based on some academic or practitioner research, either we've done or other people have. And a lot of it goes back 100 years. For those who know us long enough, the 2 pillars we really focus on are value and trend. Both go back over 100 years. Next, it has to be something I want to put my own money into. So many issuers just throw everything against the wall and sees what sticks, right? And I always laugh when people talk to us as a small issuer. They say, Meb, I'm worried about you closing funds. I say, are you kidding me? Look at these big dudes. They close more funds than anyone combined on these smaller shops, because they take this approach where they're not putting their own money into these funds. The last thing for me is I want to put my own money to. I put all my public net worth into our funds. The average mutual fund manager has zero invested in his own fund. And it's even a higher percentage if you say less than 100 grand. And so as I was looking around, I said, I want a fund that I can use that hedges my portfolios, that we can either use on a tactical or standalone basis. And I looked at the inverse category, and I just saw nothing that I liked. It was either really expensive or it was so confusing, I didn't even know what to do with it. But so we took a step back and say, look, let's think about how to hedge a risk in the first place. Let's say you have too much in stocks. You're listening to this, you have all your money in US stocks, and it's got a huge capital gain. You're not going to sell it. You say, how can I hedge this? Well, the first takeaway is always not to take the risk in the first place. If you have 100% in stocks, maybe have 80, 60, 40 to get to the point where you sleep at night, but it doesn't even apply to stocks. It can apply to houses, cars, you're over leveraged. Just don't take the risk in the first place. But if you do have something like US stocks, you could buy foreign stocks like we talked about earlier. Tilt towards value, I think, is something that will be particularly helpful. Diversifying into other assets. A lot of people diversify. So there's kind of 2 buckets here. And we looked at this historically in a paper called Worried About the Market that you can find online, it's free, where we said what assets historically hedged the S&P when it had a really bad month or a really bad bear market, down 50. The things you would expect not to help, on average, didn't help. Real estate didn't help. Commodities didn't help. Foreign stocks, on average, didn't help. They're still stocks. The things that did help, historically, you would expect them to. Bonds had a high batting average. They helped most of the time, though often they didn't have like massive returns, but they were positive on average. Gold helps, but gold is kind of like your crazy cousin. Like you don't know who's going to show up. Sometimes that helps a lot. Sometimes it's down 15% in a bad month. And so, by the way, that was the exact playbook in 2020. So when it hit the fan, real estate, foreign, terrible. What was good? Bonds, gold. So gold helped this year. And then you can do some active stuff, trend following, which we're not going to get into today. Historically has helped. This year, depending on the strategy, it went from anywhere from terrible to wonderful. Mostly we're just kind of okay. They did okay. And then lastly is a strategy that's almost designed as an insurance concept, which is tail risk. And tail risk has been in the news a lot this year, obviously because of what's happened. But it's an idea that we've had as a fund. It's been out over 3 years now. And so how do we think about it? The way we do it is we said, look, there's 1,000 permutations on how to put together a tail risk strategy. I want mine to be simple. 90% of the fund is in government bonds. We target 10-year. And then with the rest, we buy a ladder of puts in the stock market, ranging from 3 months on out to like 15 months. Here's another performance disclosure slide. We'll look at this more later online. And this is real time what the fund's done. And I think it's a pretty good indication. You've had a lot of different regimes in the past few years for what markets have done. If you guys remember back to the last election, I think I gave a talk to AAII, and I said, first of all, the outcome of the election has how a Trump or Clinton presidency will affect your portfolio. And we went through this whole thing and said, first of all, it won't. What really will affect your portfolio is something you're not paying attention to, which is fees. And I actually redid that article just recently online with Biden and Trump, and you guys can look it up and find it, and the same concept as well. But 4 years ago, going into the election, and by the way, you guys want to predict who's going to win? I can give you with 85% accuracy who's going to win. And it's in the 3 months going into the election, is the stock market up or down? So about last year, about this time, I tweeted out, I said, Hillary's camp better start buying stock market futures because the market was down. And traditionally, when the market's up, the incumbent party stays in power. When it's down, they don't. And you can actually take this back about 100 years. So how's it looking right now? It's we'll see. You guys, there's a lot of conspiracy theories about what's pushing the market up the past few months. We'll see what happens. But my point being, interesting things have happened since 2017. The first time in history we had the stock market go up every single month in a calendar year. I think we tied or broke the longest streak of up months in a row. Then we had the 2018 romp down, 2019 up, 2020, we all know what happened. But you can kind of see from this chart, the red line is the S&P, blue line is cash or short-term treasuries. The blue line is tail and the orange line is the category. And if you zoom in on just this year, for example, well, there's a couple takeaways. One, on average, we would expect tail risk strategies to be a cost. Okay, just like you think about insurance, the bond component helped much more when bonds were at 4 or 6% yield than they are now at sub 1%. But you still often, and it's not guaranteed, the bonds help on a capital appreciation basis when it hits the fan. And so you can see that this year in the first few months of 2020, you can see tail and the bear category did a great job. Now, the big difference, I think, is that the challenge with a lot of the inverse category in general, which makes it so hard for people to own, is that it often gives it back. So it ends up looking like a mirror image of the S&P, which is great when it hits the fan, but unless you have perfect timing, can end up losing a lot of money when the S&P does well, which it's had this year. So if you had bought a lot of the bear category funds at the beginning of the year, wonderful, it protected you, but now you're down 20% plus. Whereas if you do the approach with bonds and options, hopefully when the S&P is up, you don't lose all that. Our expectation, broadly speaking, is that this fund will do about a 1 to -1 correlation with stocks. So if stocks are down 20, we would broadly expect this fund to be up 20 and hopefully lose less when the stock market's up. Now, as you think about how to use a fund like this, and I mentioned fees already, it's the cheapest fund in the entire category. Again, it's not screaming cheap like some of the Vanguard funds, but relative to the category, it's much better. If you're an advisor listening to this, or if you're a professional in the asset management business, I think there's an extra consideration. And this consideration is an anti-consensus view. Most people do not believe this, but I like to, this whole talk, by the way, you may go finish this and be like, that guy was a total moron, but he made me think a little bit. And this is one of those points to at least consider. So hopefully I've talked you into at least thinking outside your borders or states. And by the way, it happens even within the US, the home bias. If you're in California, you own more tech stocks. If you're in New York, you own more financials. If you're in Texas, you own more energy. You can't make it up. And in this part, I just want you to think. So when you think about risks, let's say you're a financial advisor at a traditional wirehouse like Morgan Stanley or Merrill Lynch. We often say those people don't know it, but they're at least 4 times leveraged to the stock market. One, they own stocks in their own portfolio, US stocks. Even if it's diversified US versus bond, the US volatility swamps the bond volatility. And we know from our earlier discussion that most people invest mostly in US stocks. So it's basically a US stock portfolio. Second, their clients own stocks. Your revenues are directly tied to your clients. So when the stock market goes down by 50%, your revenues just went down by 50%. Clients often, and this isn't just individuals, this is institutions too, when things hit the fan, and it's not always just like saying it's their fault, but often they have no choice. They just need to get liquid. They may be upside down on the house. They may have lost money elsewhere, need to pay bills. They need the money, so often sell at the worst time. So they'll often withdraw during a bear market. So you may lose clients. And on top of that, if you don't work for your own company, as you've seen in 2020, companies, when they get into trouble, they have to downsize. You may get fired. So you're like 4 times leveraged the stock market. You could make an argument that the average financial professional should own 0 US stocks. Not only should own 0, should own negative US stocks, meaning they should be hedged to that to balance out their earnings stream on a personal and professional basis. People always listen to this, they're like, Meb, you're crazy. But people do it in every other portion of their life, as well as companies do it in every other risk. You own home insurance, you own life insurance, you own car insurance. In no way does anyone ever question those 3. Companies hedge their risks. If you're a cereal company, you hedge the price of wheat. If you're a beer company, you may hedge the other inputs and hops or whatever it may be. If you're a airline company, you hedge the cost of oil, of fuel, jet fuel. But when you tell people as applied to stocks, they kind of scratch their heads. I probably own a higher percentage of this fund in my personal and our company's balance sheet than probably anyone in the country. I think our company is approaching almost half on its balance sheet, and I own a significant portion as well. Not quite half, but a big portion for these reasons, to help balance out the good and the bad times. Real quick on how people think about using this, by the way, there's sort of 3 ways. One is the all the time insurance I talked about. Hope it never happens again, but if something like March happens again, this election drags on to January or who knows when, all the crazy stuff happening in our world, pandemic, hopefully it just goes away, just disappears into the ether, but you have to be prepared for it doesn't. So a lot of people want this sort of all the time insurance. Behaviorally speaking, if you're a financial advisor, it's nice to have a narrative, something to talk to a client where you can say, look, everything's red, but at least something is green. And obviously you can't guarantee it, but puts are designed to participate when stocks are down. The second way, people use it tactically. Hey, I think stocks are expensive. I think stocks are going down. I'm going to hold it throughout the election, yada, yada. People also use it as what I call bond replacement. And this is an area, you guys will have to have me back if you'll have me in 2020 or going on, to talk about ideas on what to do with your bonds. Bonds in the US yield less than 1%. And if you have an advisor that charges 50 or 100 basis 1%, you're already negative. So bonds may help in sort of a deflationary environment, but if you look at the rest of the world, bonds are already negative. And how do you think about bonds then? You should at least think about it, because that's something that possibly could happen. So a lot of people that want to bring down their equity exposure with US stocks, you can simply swap out the government bonds you already have for a fund like this, because it gives you 90% in bonds already with the options overlay. And so, by the way, going back to your earlier comment about the Fed, it wasn't 5 minutes, it ended up being 30 minutes later. The Fed model and interest rates, stocks looking more attractive relative to the US. We'll flip that to the rest of the world. Bond yields the rest of the world are negative. They're lower than the US. US is a high yield bond market in 45 countries around the world. So that means the stock valuations in the rest of the world should be way higher than the US, because their markets are negative yielding, but that's not the case. Stock valuations are way lower, which is exactly backwards of what that argument rests upon. So this Fed model valuation of, hey, stocks should be much more attractive, I'm willing to pay a lot more when bond valuations are low, doesn't work in 44 of the 45 countries. It's only as an excuse in the US. All right, so I'm gonna wind down. We'll get to some more questions. Quick summary, talked about a lot of weird stuff today. First, I think stock markets are expensive in the US. Not crazy, but at least consider looking abroad, looking at broader borders for some opportunity. A good example today that I tweeted out, I said, by the way, question, what do you think the GDP of emerging markets are? 0 to 20, 20 to 40, 40 to 60, above 60. Everyone said 0 to 20, 20 to 40? The answer is 60. 60% of world GDP is emerging markets. The average index allocation of emerging markets of the world is 13%. The average person in the US who allocates puts in 3%. So GDP of 60%, you're only investing 3%. There's a big disconnect. I put all my 401k into emerging markets, which sounds crazy to most, but we also do a post I call how I invest my own money that you can look up online too. So at least consider looking abroad. If you lived through 2020 and it was not a fun experience with your portfolio, you couldn't sleep at night, something is wrong. We have an old article called Zero Budget Portfolio. Start with a blank piece of paper tonight. Write down what your portfolio should look like or what it feels like. If you have too much stocks, think about reducing it. Think about diversifying. Think about active strategies, and maybe consider an insurance type of allocation like tail risk. And lastly, consider your costs. We talk a lot about costs everywhere, and this isn't just expense ratios. It also involves things like short interest lending, transaction costs, taxes. We love the ETF structure. Obviously, we're biased, but we think that's a significantly better structure than many of the legacy high fee vehicles that charge over 1% and they're tax inefficient. I'm going to wind down, you guys. Thanks for enduring this for so long. I appreciate it, and we'll stick around as long as you guys want for questions.
Definitely. Thanks a lot, Meb. That was a great presentation, very informative. I think, yeah, your points about thinking outside your boundaries for opportunities, I think that's a good one. I liked you sharing your thoughts on the Fed model valuation and talking about insurance tail risk. So lot of questions came through. So let's get to a few of those. Just give me one moment to look through here. All right, let's see. There have been a few questions. Dilip asked and a few others. They just wanted to get your thoughts on, with the Fed and the federal government injecting so much money into the economy. They were curious just to get your thoughts on, how you think that's impacting the stock market in general, and just where we're going from here.
Sure. Well, the Fed's been around for 100 years now, and governments and politicians have been mucking around with markets for as long as politicians and markets have existed. We've had quite a few different regimes over the past 100 years. Used to be on a gold standard. We now have a floating interest rate, floating currency environment. I mean, things are never exactly apples to apples. But let's go back 2,000 years. We did this book, Global Asset Allocation, that's free, that looked at the top asset allocation strategies that have been recommended by various gurus and money managers that manage collectively in the trillions. People like Rob Arnott, people like David Swinson, Warren Buffett, that have suggested various allocations. And one of the best performing is an allocation that's 2,000 years old. And it's from the Talmud. And it said, let every man invest a third in business, a third in land, and keep a third in reserve. And fast forward a few millennia, and if you extrapolate that to mean a third stocks, bonds, and real assets like real estate and commodities, that's a really good portfolio. And so much of what we say on the buy and hold allocation side is you come up with an allocation that should perform in any market environment, and then just leave it alone. For a lot of people, it doesn't even matter what it looks like. In the book, we actually demonstrated that it doesn't matter at all, really, what the allocation is, and most people spend way too much time obsessing over that. But what really mattered is you implemented it with low costs and low fees, and then just left it alone. And so, will you have a situation where governments are involved? Sure. And it's either going to result in one of two things in a few different boxes in various regimes: inflation, deflation. So you have assets that protect in both. Deflation, the bonds help. Inflation, the real assets and stocks should help. Growth versus recessions and contractions, same thing. And so times when the US outperforms, times when the rest of the world outperforms. So diversifying across tens of thousands of securities, you can do that with an all-in-one fund today. We have one that does it, our asset allocation strategy, but you can buy these for essentially almost free with ETFs and get exposure to these allocations. If you don't trust yourself, get an automated digital service. If you don't trust yourself with a digital service, get a financial advisor. But the impact of governments will always be felt. And the good news is that the flows over time, no one's big enough to distort markets forever. We've learned that lesson over and over and over again, and eventually they find equilibrium. So the optimist in me every day sees amazing startup companies that are just crushing it, and even a lot of our public companies just world changing, but they don't stay the same. If you look back at the top 10 companies 10 years ago, 20 years ago, 30 years ago, we're not talking about RCA anymore. We're not talking about GE. I mean, we may have been 10 years ago. We're not talking about Exxon, which not too long ago was a top 10 company, but isn't anymore. So you'll always have the creative destruction of free markets. And the beauty of owning everything around the world is it gives you diversification across making a very active bet. So yes, will the Fed continue to do things? I have another anti-consensus view that I think they've done a pretty good job. No one likes to hear that. Everyone loves to rant about the Fed, but I think they've been fine. And that's not going to get me any points on CNBC, but I don't worry about it too much.
The anti-consensus view, I like you sharing that with us. It's sometimes good to hear the other side. So no, keep coming with it. I'm just gonna go down here, a bunch of questions. We have one from Glenn saying, hey Meb, any plans on updating your famous QTAA white paper in the near future?
Yeah, that paper, which we published back in 2006, we've updated a few times, and we actually did a 10-year retrospective for the Journal of Wealth Management. That does remind me that I need to reach out to them, and hopefully it's not behind a paywall anymore. SSRN is where it traditionally resides, and we kind of look back and see how it's done, and try to have a nice takeaway on trend following in general. There are some sites that track it live, so if you go to my blog at Meb Faber and hit the timing model tab, there's about a half dozen sites: Allocate Smartly, ETF Replay, Extra, Dash, Portfolio, Visualizer, I think. There's a bunch of these sites that actually track it in real time, so you don't have to take my word for it. You can just go click on these independent sites and see how it's done. The big thing with trend is in some areas it's helped a ton. I mean, think about oil or real estate and commodities. I'm a farmer, so agriculture's been in the tank forever. And then even with foreign markets, and sometimes in places it doesn't help. And in a world of romping and stomping US stocks being the main game in town, it never looks as good. But the beauty of trend following, and we talk about this in our Trinity concept, buy and hold is just fine. I love buy and hold. We run one of the lowest cost buy and hold funds in existence. Problem with buy and hold, back to our hedging cost topic, is that buy and hold often does poorly when everything else is hitting the fan. So during a recession, during March of 2020, theoretically you would want a portfolio strategy that at least zigs and zags a little bit. And so trend following historically has been that strategy. Kind of like value though, it hasn't been a great place to be for the past 10 years. Do I think it's a desert island strategy that I would want to have a big allocation to for a long time? I do.
All right, we have another question from Robert, and he wants to know what do you think is the best numeric of quote unquote risk that the average investor can understand?
So I think if you gain an appreciation and some rules of thumb for asset classes historically as a starting point. So any one asset, and so we did a 4-part series this year, by the way. The first part was called the Get Rich Portfolio. The second part was the Stay Rich Portfolio. Third part was investing in Krona during the time of Krona, and lastly was how I invest my money. An interesting takeaway is that if you think in terms of nominal versus real, so real returns after inflation, if you were to ask most investors, look, you're rich, you got 10 million bucks, what's the safest thing you can invest in? Everyone would say cash or bonds. But it turns out there's a different risk there, and it's not usually price drops, it's your money getting eroded by inflation, which people who were around in the 70s can certainly remember. And so bonds and cash both lost half during that period. And so one of the best strategies to come up with is a safest strategy is you actually have to invest that cash is safer and has a higher yield than cash alone. So putting some money in stocks and real assets actually does a better job than cash alone. And that's a pretty different view that most won't tell you or agree with, but you absolutely can't argue with the historical data. So drawdown is always a big one for me. Volatility, it rhymes, but having up volatility, of course, is different than down volatility. Anyone can tell you the real pain of losing money is a lot different than the joy of gaining it. But so having an appreciation of historically, we talk about a rule of thumb of 5-2-1. So after inflation, stocks have historically returned around the world about 5%, bonds around 2, bills around 1. And that's kind of rounding up on the bonds and bills. I think it's probably 5-1-0 or 4-1-0 now. But that gives you a pretty good expectation. But with that, stocks in most markets have declined 60-80% before. So you got to be pretty prepared for a catastrophic loss. And that's just with the big indices. With obviously any individual position or sector, 80% plus, 100% is a possibility. But with bonds, to me, the answer is not 0 drawdown, which T-bills have on a nominal basis. It's actually 50. So thinking in terms of after inflation. So drawdown on a real basis is a big one. We have all these numbers in that GAA book, and things like Sharpe ratio and volatility can help. But drawdown to me is a useful one.
All right, thanks, Meb. Let's see, have another question, and the question starts, as a retiree, I need income. I cannot get anything out of bank savings accounts or CDs, so I am putting more money in the stock market, perhaps along with millions of like-minded people, thus maybe causing prices to go higher. What's the problem with this type of reasoning, they're asking?
Well, there's two parts to this. You'll certainly continue to get some income through dividend yield. The problem is your principal can and easily go down 20, 40, 60% at some point. Charlie Munger famously says, if you're not willing to sit through a 50% loss in quoted securities, you shouldn't be in them. So that's the one problem is you can have a massive loss. Now, if you don't need to touch that principal ever, and you're just going to be spending your 2% dividend yield, which is what you get with stocks in the US, then you're probably okay, and you can sit through that. A lot of people can't. The principal matters to them. And so then this is a challenge you're going to continue to hear more and more from people is where can they find investments that do have yield? We've talked about a lot of things on the podcast. Farmland is one that's pretty wonky and hard to allocate to, real estate. There's a lot of discussion of alternative assets. But if you're thinking about income, look, the rest of the world has a much higher dividend yield than the US does. So thinking about having some there too, I think is important. Now, real income, the bad news in the US is you talk to a lot of the big quant shops. This is one of the worst opportunity sets in 100 years. So having some dry powder, I think, and not betting the farm is important. And thinking about having something like our tail risk fund, honestly, where it can help or at least hedge the downside and protect against some of these catastrophic outcomes that are possible. Maybe not probable, but certainly possible.
I appreciate that as a manager of our dividend investing service. It's good to hear your thoughts on dividends. So thanks for sharing that. We have we'll definitely go a few more questions here if you have the time, Meb.
Sure.
John is asking, do you think the advent of small and slice sales of equities in the hands of lots of small investors makes market either more variable or more manipulated? And is herd mentality now more important? Or
Oh boy, that's two deep questions. The first one is no. I mean, look, we were around in the 90s. I had an E-Trade brokerage account. My professors during engineering classes were trading stocks and looking up their IPOs. Now we call them SPACs, but the words changed, but they rhyme. And we all know from these periods that they don't stand a chance. And you're a day trader. You remember the Forex brokerages have to disclose in their prospectus what percentage of their customers lose money. And I think the number was like 98%. So, these challenges, if you take a step back, I mean, the bigger issue is we don't teach personal finance, money, wealth, investing in school. Forget about college, high school, middle school. And we often ask 17-year-olds to make a decision on hundreds of thousands of dollars of going to university and taking on debt as if they're not an enormous bag of hormone soup at that period and have had no education. And so the challenge with people investing is A, there's no foundation, and B, even when you do, it's hard. The best thing you could do is get started early. The best thing, what swamps all of this, and it's not even close, is how much you save and how much you invest in the first place. It doesn't matter what you invest in, I believe, as long as you pay low fees and just leave it alone. So all of the challenges of being human, to the second part of the question with the behavioral and herd mentality, flows absolutely change asset classes. If you put $100 million into Brazilian small cap healthcare stocks, that's going to change the asset class. It'll push it up. I don't know what Vision Fund's been up to with some of their option purchases. Maybe it's nothing, but certainly if you push a bunch of money around in one particular area, you can move assets. And look, longest history, people are drawn to investing returns in the exact opposite way they should be. They get excited about things that have gone up. They wish they had bought. They buy what they wish they had bought 3 years ago, last year. And so all these challenges, to have your head about you, I love bringing up the AAII survey as one of my cornerstone examples of behavioral finance, where the AAII survey, the most bullish it's ever been, was in December 1999 at the highest CAPE ratio in history on stocks, when everyone wanted to buy stocks. It was literally the worst month in 120 years to buy stocks. And when were people most bearish? It was in March 2009. So look, we're human, but the good news is once you realize that, you can put up safeguards to protect yourself. You can have rules. You can rebalance. I don't think markets are any different. You read all the historical books, Extraordinary Popular Delusions and the Madness of Crowds, and see how people behaved in other times throughout history. I mean, the crypto bubble wasn't too long ago. That was about a year ago. Watched all my friends go insane and buy all these coins that have gone down 99% since. So just be careful, be thoughtful. No decision you ever have to make has to be made tonight. And usually if you sleep on it for a few months is usually a sound idea.
Yeah, thanks for bringing up the AAII Bear Bull survey. I've heard people say it's quite a contrarian indicator.
Well, the problem is we all talk about it now. So I'm actually worried that it's going to stop becoming a good indicator now that everyone knows about it. But there's a sister study by, I think it's Institutional Investor, that goes back to like the 50s or 60s. And it's the same thing. Luthold, which is one of my favorite research groups, looks at the average sentiment across a year. And so the 10 most bullish years going back to like 1960, the following year, the returns were 0 on average in the stock market. And the 10 most bearish years, the next year, the returns are like 20%. So it's the same thing asked differently. The problem with sentiment, of course, is it's sort of anecdotal. It usually only matters at extremes, and it's nothing that I would like bet the farm on. but it's good to be able to take a step back. Was it Kipling, when you can keep your mind when all others are losing it around you. So that's why valuation helps. You can say, look, okay, markets historically have been at 17 PE. If they're trading at 40 or 50, maybe I should take some chips off the table. This wasn't that long ago. India and China were at 40 and 60 in the mid 2000s, and they've had horrible performance since. And Japan, by the way, it's taken 30 years just for them to get back to even on their stock market from the 1989. So having these guideposts give you a little, okay, what's the common sense thing to do, sort of takeaway, which I think is important, particularly when everyone's going crazy and particularly when everyone's making a ton of money. That's the worst thing that can happen. Your neighbor starts making a ton of money, buys another house, buys another car by leveraging up his account and a bunch of shares of Tesla. It's hard not to get caught up in that envy.
Oh, definitely. Those are some good things to think about. Just going back to earlier when you were saying, think outside your boundaries for opportunities. There's a lot of questions. There was one from Jordan, Andy, and they were just curious how they should think about the impact of currency risk, foreign government risk, et cetera, when they're looking at those other opportunities outside their normal boundaries.
Yeah, I mean, first of all, if I don't get to all y'all's questions, feel free to email me, and I'll hopefully get to everyone. Looking back at our history as a country, but also every country around the world, many countries, I mean, it was not that long ago, we went through a civil war. Our country hasn't existed that long in terms of history of timeline of human and events. We've only had a floating currency regime for what, 50 years. We talk about it sounds like a really long time in markets, but it's really not. And you look at a history of all the countries in the world, the empires growing and falling and everything in between, there will always be these risks. There will always be political risk. There will always be, 50 other risks. I mean, guess what we found out this year? There's pandemic risk. I did a tweet at the end of the year, and I said, historically, decade ends often mark turning points in markets. 1989, the Japanese bubble ended. 1999, the US internet bubble ended. 2009, global financial crisis. I wonder what this decade turning point will bring. It only took 2 months. Turns out it was a pandemic. No one was talking about that in December, right? As a risk. So I think people spend way too much time thinking about governments and the things that are known. On this article where we talk about Biden and Trump, I say, people are scared of sharks and lions and everything else. What kills the most people? It's the mosquito. I think humans are number 2, and dogs are, I think, number 3 or 4. Man's best friend. And then like the next 2 are like snails and worms. Nobody wakes up is like deathly afraid of snails and worms or mosquitoes. But the point being is that everyone's afraid of what's on the news. And the problem with being a public market investor is you're absolutely bombarded with consistent negative news flow. It's hard to be a public market investor. I actually encourage a lot of people to spend some time, whether you have the assets to do it or interest, to spend some time on some of the startup investing communities like AngelList or maybe WeFunder or in your local angel community, because it's the exact opposite. It's the most optimistic thing in the world to listen to a lot of brilliant startup investors thinking about ideas that are changing the world, not only brainstorming them, but putting them in practice. And it's a nice balance, because if you're a startup VC type of investor, you're like, all you want to do is put all your money in these companies. I mean, they're unbelievable. Some of these ideas, I'm like, we're living in a science fiction novel. And then you're a public market investor, and you're just like, this is the most depressing time to be alive. So trying to find a balance is hard. But again, being a quant and having some rules to safeguard against all these things. And that's why you diversify, too. If you have a extended environment where, it wasn't that too long ago, 2000 to 2009 was a horrific time for US stocks. And people act like that was like a century ago. And you had 2 massive bear markets in that period. So, it's been a romping party this decade, and who knows, it could be this decade too. But that's why you diversify, is you eliminate the outcome potential of one negative outcome.
Hey, Meb, definitely appreciate your time. I think we'll just have one last question, and then we can let you go on your way. It's definitely been very informative. There's a ton of questions that we haven't been able to get to. So would you mind giving your email to folks, or is that in the presentation?
We touched on it a few times in the presentation. If you want to watch it again, I have the easiest email on the planet. But if you go to the Cambria Investments website, you can either go info@cambriainvestments.com or my initials, mf@cambriainvestments.com. They both should get to the same place.
All right, great, thanks. So just the last question, we'll stick with the ETF theme. There was a question, do you have a ranking for companies or countries in emerging markets that are best for new money, ETFs in those countries? And we'll end it with that, and then we'll turn it over to Ryan. So
I thought the question was going to be who's going to win the Broncos Patriots, and the answer is obviously the Broncos. We got Drew Lock back finally. Emerging markets. We have an emerging markets fund, EYLD, that focuses on shareholder yield companies in emerging markets. In emerging markets, some of the worries that I think people had that you mentioned earlier about rule of law, freedom, governments, et cetera, I think are actually a consideration in emerging markets, and investing in companies that are not diluting you, which is a big problem in emerging markets because they're consistently issuing shares, but rather are paying out dividends, buying back shares, but also trade for a low value, I think is a sensible approach, which is what we do in our fund. That having been said, we have funds that go both top down, so they select countries like global value, and we have funds that go bottom up, so they select stocks regardless of country, and they actually end up with pretty different allocations. But the funny part is they end up in the same place. So the big muscle movement of using value in the first place and not being market cap weighted means you end up in this part of the universe instead of this part. As far as actual countries, I mean, look, we publish this valuation update on a quarterly basis, which is no reason to do it. You could update it once a year, once every 3 years, probably not going to matter. Value correlates very highly to drawdown. So the stuff that's cheap is already down 40, 60, 80%. The stuff that's expensive is usually at all-time highs. But let's see. I mean, the cheap stuff around the world, if you're just talking about valuation, you have Russia has consistently been there for a while. Czech Republic, they're a much smaller market. You can only really buy like 10 Czech stocks and have them be liquid versus a country like Japan where there's thousands. A lot of emerging Europe is pretty cheap with Poland. Then you have things in South America like Colombia now is cheaper again. What else in South America? Brazil has had a crazy 2020. They were romping and stomping, and then they absolutely gotten pummeled. They've been through kind of their own Great Depression over the past few years. But the names change. They're not always in the cheap bucket. US isn't always in the expensive, and they kind of cycle in and out. Yeah, you can go to the website and get the full list.
All right, great. Well, I wanted to thank both Meb and Derek for their time tonight. I know we went a little bit long, and thank everybody who watched tonight's broadcast. I wanted to show folks our upcoming schedule of webinar Wednesdays. We do this every Wednesday at 7:30. Next week, we are featuring Chris Pedersen of the Paul Merriman Financial Education Foundation. He's going to be talking about simple and effective balanced portfolios for lifetime investing success. I believe that talk is about target date funds and diversification. So that's next Wednesday, October 21st. And then the following week on October 28th, our AAII's own Charles Roplet is going to be putting on a webinar called Putting Investing Preferences to Work in Your Portfolio. It's the next in his series about the individual investor wealth building plan, help folks kind of build their own financial investing plan. That's October 28th, 7:30 Central. Again, thanks to Meb and Derek, And thanks to all of you. We will have a replay of this webinar on AAII's YouTube channel tomorrow, along with links to the various resources and articles that Meb talked about tonight, as well as the handout. So with that, we wish everybody good health and good wealth. Good night.